Against this backdrop, the MPC decided to reduce the policy rate by 25 basis points with effect from the 30th of May. 5 members favored this action, while 1 preferred a cut of 50 basis points. While the inflation outlook appears benign, we considered an adverse scenario which illustrates the upside risks. This was based on a global slowdown triggered by escalating trade tensions where the rand depreciates sharply. The scenario showed how a country with some fundamental vulnerabilities like South Africa risks stagflation, with growth moving lower while inflation rises due to currency weakness. In these conditions, monetary policy tightens to stabilize the macro economy. In this meeting, we also considered a scenario with a 3% inflation objective, which corresponds to the low end of our target range. For some years now, internal and external analysis has shown that our inflation target is too high and too wide. The National Treasury and the South African Reserve Bank have engaged extensively on this issue, and technical work is at an advanced stage. Now that inflation has slowed, we have a chance to lock in lower inflation at low cost. This scenario illustrates that opportunity. For a 3% objective, our quarterly projection model shows a lower path for interest rates. Both our baseline and the 3% scenario have a cut in this quarter. However, rates move steadily lower in this scenario as inflation comes down. The policy rate falls to just under 6% rather than staying above 7% as in the baseline. Inflation expectations stabilize at 3% during 2026, helped by the experience of lower inflation. Growth is somewhat slower at first because real rates are initially higher, but the economy does better later in the forecast as rates ease further. The MPC is of the view that the 3% scenario is more attractive than the 4.5% baseline, and we would like to see inflation expectations move